An equity-linked savings scheme, or an ELSS, is a type of equity diversified fund which invests a majority of its asset in equity shares of companies. So the next obvious question is, how does an ELSS fund work? Well, the fund manager maintains a well-diversified portfolio by allocating resources across sectors, market capitalization, and industries. The net asset value, or the intrinsic value of one unit of fund, fluctuates with ups and downs of underlying benchmark and overall economic factors. The investment mechanism of ELSS is such that the fund return tends to get affected by overall movement in the equity market. The objective is to keep the portfolio returns in line with expectations and not to let it be affected by extreme price movements in one of the industry segments. However, the fund attempts to generate enough returns which results in capital appreciation and tax benefits over the long term. Now let's talk about the key features. Unlike other funds, ELSS comes with a lock-in period of 3 years from the date of investment. It means that if you initiate a systematic investment plan or an SIP in an ELSS fund today, it will not be available for redemption before 3 years from now. You may exit, redeem, or reinvest your units of ELSS funds only after the expiry of the 3-year period. Just like any other equity fund, ELSS funds are available in both dividend and growth options. From a tax standpoint, up to 1 lakh rupees of long-term capital gains from an ELSS scheme is tax-free. LTCG of over and above rupees 1 lakh is taxable at the rate of 10%. Under Section 80C of the Income Tax Act, your investment up to rupees 1.5 lakh can be claimed as a deduction from the gross total income in a financial year. Now let's talk about the risk factors. An ELSS predominantly invests in equities in addition to other asset classes. These are suitable for investors with a relatively high risk-taking capacity. However, when compared with small cap and mid cap funds, ELSS funds are safer because the volatility is much lower vis-a-vis the former. As these funds carry higher risk than debt funds, their return generating potential is also higher than the pure debt funds and balance fund. Now here's how you can choose a top performing ELSS. Shortlist funds which have a relatively long fund history of say 5 years. Ensure that the fund's returns are the result of the fund manager's expertise. You may choose fund performance which matches your investment horizon. Ensure that the fund's philosophy is in line with your financial goals. Scrutinize the fund's expense ratio and check whether it justifies the fund's alpha. However, at the end of the day, you need to remember that the fund returns are not guaranteed. ELSS funds are a smart way to save a lot on your tax outflow. But you need to bear in mind that the returns are not guaranteed. Consult your financial advisor before investing.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.